This may be the most important conference you ever attend for all your business, etc. in the future. So, welcome to Fund Launch Live. I was thinking about this group that was coming today, and we had a sold-out crowd, and it was just amazing. And I was kind of asking the question, like, who should I base my talk to? Who should I speak to? Should I speak to people that already run existing funds, people that don't run funds yet, people that don't even know what funds are, people the first time here, people that were here last year? Like, who's my direct person I talk to? And we finally came to, I said, I'm going to talk to my 2019 self. I'm going to talk to my younger self. And I'm hoping there's one or two people in this crowd that's like a younger me, whether that's actually by age or by in business or this category or whatever, but can come and say, I'm going to have an event horizon. Also, I want you to feel totally confident in the next 12 months that you can come up here and win on stage a pair of shoes running a $10 million fund. I want you to feel confident that you can do that and be up here next year and set that goal in your brain, like, I'm going to be there. And it's cool for people, a bunch of people from last year, like, dude, I did it. The last 12 months we're here, and they're going to be up on stage tomorrow getting their awards, okay? I want you to be there. So what is a fund? We're going to talk way basic. Fund launch live, fund launch. Like, what even is a fund? What are we even talking about? All a fund is a pool of money. Investors put money into that pool. People like me and you can draw from that pool. We can go make investments. We go buy assets. We'll share a few examples in a minute. Whenever those assets make money, they flow back to the pool and get split between ourselves and the investors. That's it. I'm going to share an example of how one of our, actually people in our group went from flipping, any house flippers in here that do, I'm sure a lot of you guys have flipped a house or changed houses. He flipped 3 to 4 houses a year. Next year, flipped 70 houses. I'm going to share exactly his example. Sound good? So this is what he did. I'm going to summarize you house flippers. I'm going to summarize your entire job in about 30 seconds, okay? Here we go. You guys find a house. Looks awesome. Let's fix it up. We then go and we got to get money for it. So we get hard money, investor money, bank money, or your own money. We get that money together. We put it into an LLC. We have a little operating agreement. Throw the money in. We then go flip the house. We renovate it, do all the stuff. We then make a little bit of money. Yeah, we're making some money. Okay, feeling good on the way to the bank. And then we start over. We find a new house. How did I do house flippers? Is that pretty good? It's your whole job in 30 seconds. And that's a good job. You make actually good money. There's good money in house flipping. So this is what I like to call the syndication loop. And by the way, syndications are awesome. Some people keep asking me, like, Bridger, are you like anti-syndication? No, syndications are amazing. They're great to build your track record. It's a great way to get some deals under your belt, get going. But this gentleman we talked to, Brent, he was like, hey, I want to do the next thing. I want to do more. It's hard to get economies of scale. So we said, hey, what if we set up a fund? So instead of every single deal, you're raising your money, trying to go to the courthouse, calling people Friday afternoon, wire your money in, etc. You set up a fund. You raise the money once, you set up the legal documents once, and you can go flip as many houses as you want over and over and over again. That's what he did. So he set up the fund once, money once, and then, ta-da, he went and flipped 70 plus houses in 1 year. And also, he had economies of scale. So think about this. Do you think you'd win more deals or less deals if you had a fund ready to go versus like syndicating trying to get money in the fund? More deals or less deals? More, right? Do you think you'd get better financing or worse financing from banks with a fund? Better or worse? Probably better, right? Because you have a relationship, you're doing more deals, you have more capital, you can probably get better interest rates. So all of a sudden, ta-da, he now can do more deals cheaper, and he has economies of scale. He can hire multiple crews that go from house to house, and he has economies of scale, which makes all costs go down. Pretty cool, right? Okay, how this works with businesses. This is actually a true example. This guy calls me. He has a gun store that does $10 million a year, roughly, okay? Selling guns. He's like, Bridger, I want to scale. So what's my options? And typically, we think the options to scale a business are, we call up like Kevin O'Leary types. Hey, I'll give up 20% of my business, put money in, and then we'll go scale. Or I'll get some debt. So I'm going to go to the bank. I'll get like an SBA loan or a debt loan, etc. And that's how we're going to do it. We have a bunch of debt on the business. It's typically what people think of. And I said, hey, there might be a third option. You want to hear what it is? It's called a fund. So this is what we're setting up for him actually right now. So he has a gun store. You set up an outside fund. See how I separated those? So outside fund, you raise outside capital for this fund. That fund comes in and buys the competitor stores. Because he wants to go and buy up all of his competitors in a certain region. So you use that fund, you go buy your competitors' stores, and then, hey, guess what? You're pretty good at running gun stores, right? Let's contract you out Let's pay you a 5% corporate fee to come run the gun stores for us. And you can put your branding, your logos, etc. That's what the fund will pay to have you do all this. So ta-da, the fund goes and buys, let's call it 6 or 7 competitor stores. They contract his existing store. They pay maybe a 5% corporate fee to do that. He now can put his branding and logos on all the competitor stores and essentially controls them. And now he has a monopoly on a whole region of stores. Kind of interesting, right? Now, when those stores make money, the money, he pays a 5% corporate fee back to his existing business. It goes back to the fund, and they split, let's just call it 80-20 on the returns. And he's also an owner on the fund. So he makes a 20% split there, and he also gets the 5% fee there. Is that kind of making sense? You guys following along? Pretty interesting, right? Okay, chiropractor shops. We have a couple people that we've actually met that are doing this. They found they can group chiropractor shops together and sell them for a multiple. It's called a roll-up. If you've heard of dental roll-ups where they're buying dental practices together, this is kind of a similar thing. So for example, this person has a fund. They go buy, let's call it 8 chiropractic stores. They put them together. They then package them. They get all their overhead down. They get their marketing expense down because they have, again, economies of scale. We'll talk about that in a minute. Ta-da, let's say they buy them for $8 million, $1 million for a piece. They can turn around and sell them. It takes about 12 to 18 months. They sell them for $12 million. Pretty good. $4 million gain. They split it, let's just say 80-20, $3.2 million to investors, $80,000 net take home to him. Not bad. Who would like to make $800,000 doing that? Am I the only one? Yeah? Okay. That sounds pretty, I'm like, yeah, that doesn't sound that crazy. Buy 8 stores, group them together, sell them in a year to, make that much money. It's pretty cool. I want to go quick through here, but I want to talk about launching a fund and actually the process of doing it. So if you've been struggling on this game and this process, this is probably why. A lot of us are well, right here, I just want to let you know it's not your fault. You haven't had the right vehicle, or maybe you have the right vehicle of a fund, but you don't have the right training to operate that vehicle, okay? So I want to walk through the training of how to launch this. So I want to talk about a new way, a better way to launch funds. We call this the fund launch formula, okay? It's a framework we've built out to launching funds. I've had an incredible amount of amazing people sit down across me, and I've been able to interview them on my show, $100 million, billion-dollar fund managers. And what's interesting, I started to interview them on how they launched their fund, and all of them had a very similar story. They used the same process. And I was like, this is interesting. I interviewed another guy. I kind of asked him questions on this process, and it was the same process. I was like, this is interesting. And so we finally coined the phrase, let's just call it the fund launch formula. If you go Google how to launch a fund, it's terrible advice. It's terrible advice. And it's from some blog writer that had to write a blog for their quota on funds, and they went and Googled some stuff, and it's completely terrible information. So finally, I said, we got to rewrite how to launch funds, how entrepreneurs, how Wall Street rebels launch funds. Okay, so this is a 4-step process to launch a fund. We're going to dive in, yeah? Sound good? So what we used to have to do, what a blog writer will tell you, is go hire a lawyer. They're like, if you want to launch a fund, go hire a lawyer, pay $30,000 to $50,000 for a lawyer, then go pitch investors, then hopefully raise money, and if no one likes it, go back to the drawing board and start over. And you're out $50,000, and good luck. Most funds never actually launch because they go this old, dumb, stupid way that blog writers put on Instagram or whatever, okay? So this is the way we beat out the Harvard grads, the people on Wall Street, etc. If you're in this room like, I don't have a track record, I don't have the XYZ thing I need, lead with a deal. And that's what my dad taught me. So step 1 of the fund launch formula is find an amazing deal. A few other examples of great deals. I want to just give you guys more examples, okay? There are many inefficiencies across markets that money and strategy can solve. I'm going to say it one more time. There's many inefficiencies in markets that money and strategy can solve. So for example, venture capital. What's a market inefficiency that you're solving with venture capital? There are startup founders that have a great idea of minimal viable product, and they need capital to hire and grow and get that product to market. Ta-da! A venture capital fund can come in and fill that market inefficiency, and you have a great deal. Does that kind of make sense? Another example, private money lending. Anybody do private money lending, hard money lending, etc.? My dad's actually first fund was private money lending. He'll probably talk about it tonight a little bit. Over leverage, someone typically, and right now in today's market, we're seeing this more and more. You need money to float for the next, let's call it 6 months, okay? You take collateral, real estate on the loan, so you collateralize the loan. So let's say you have a house, it's $1 million. Hey, I'll give you a loan of $500,000. If you don't pay back, I'll take the house. It's $1 million. So it's a win-win. Either they pay me back $500,000 plus my interest payment, or they don't pay me back and I get the $1 million house. Right? Win-win. Does that kind of make sense? Real estate construction, again, inefficiencies in market. What they're essentially solving is there's a housing shortage. Certain people in the area want a lot of jobs, and you build more units in that area to fill a market inefficiency that capital can solve. Does that kind of make sense? Clothing brands. Anybody run a clothing brand here? I have a bunch of friends that run major clothing brands. They keep having this chicken and the egg problem. They need sales to buy inventory, and they need inventory to buy sales. There's an inefficiency there, and they try to get bigger. And I have a friend, he runs, I think it's $15 million a year, and he's like, we're still having this problem. We need more money to buy inventory, to get more sales, to get more inventory, to get more sales, and it's just this circle. So what you can do is come to inventory financing. It fills a gap in that market. Does that kind of make sense? You fill these inventory. We have people in Black Card buying shipping containers, moving them around the world. It's pretty cool, okay? This is the concept of arbitrage, okay? So the definition of, if you've heard of arbitrage, the definition of arbitrage is buying one thing in one market and selling it for a different price in a different market. It's the only definition of arbitrage. Most of us make a lot of money off of arbitrage in a lot of ways. So for instance, water in the middle of the desert, how much would you pay for a water in the middle of the desert? $10, $20, $50? How much is water worth in Costco? Maybe $1, $2. So if you can take water from one market, Costco, it's $1, and take it to a different market, like the middle of the desert or an airplane, you can sell it for a different price, and you have an arbitrage between those two prices. Does that make sense? Definition of arbitrage. So a great example, my traders in the group, long-term capital management. It's a big fund on Wall Street in the 90s. They did this. Their whole strategy was around, they found an arbitrage play between the 29.75-year treasury and the 30-year treasury. They found that the 30-year treasury was overbought because it was, everyone knows the 30-year. Very few people know the 29.75-year. Who's heard of that, right? So what they did, this is before, kind of pre all the new systems and stuff, they found that the 30-year treasury was overbought and the 29.75-year was underbought. And all they did was just play that little arbitrage. There's other groups that have done this with Bitcoin. They sell it in some countries versus other countries. There are different prices between exchanges. One exchange says the price of Bitcoin is this. Other exchanges say the price of Bitcoin is this. So what they do is just buy it on one exchange and sell it on another exchange. Does that kind of make sense? Arbitrage play. This actually happens in funds today, is arbitrage play. Is that kind of making sense? Another one is economies of scale. We talked about this earlier. Economies of scale are many products, right here, many companies would be successful at economies of scale but don't have capital to hit that point. To produce one iPhone costs, let's just call it $400 million to produce one iPhone, to get the tech and the engineers and everything. How much does it cost to produce the second iPhone on average? Maybe at $200 million. And the third iPhone, it's like $100 million a piece. And the fifth iPhone, it's like $30 million a piece. And then it gets all, once you produce 1 million iPhones, the average cost to produce each iPhone is maybe $500. It's called economies of scale, right? To produce the first one's very expensive, but as you copy and paste that model, you can have what they call economies of scale. There are many companies out there waiting and hoping for someone in this room to start a fund to help get them to economies of scale. Does that kind of make sense? They need that capital injection to get there. This is what we call asymmetrical risk for your fund. So you're trying to find asymmetrical risk. Asymmetrical risk means, we've all heard high risk, high reward, right? Asymmetrical risk or low risk, low reward. Asymmetrical risk means low risk with relatively high reward. That's that gap. It's called asymmetrical risk. That's what we thrive on. Sound good? So that's number one, find amazing deal, okay? Is that kind of making sense? You guys with me so far? So Bridger, okay, I'm ready for legal. Okay, I want to do legal docs. Hold on, that's number 4. Once you have this great idea for your fund, again, 4-step formula for fund launch, go out and frame the deal. We'll talk about this more tonight, but you go frame the deal, the pref, the catch-up carry, just how the whole deal is put together, how you investors get paid back, structure, offering deal, etc. Then, before you go do all this other stuff, go and raise capital. So number 3, go actually and pitch investors. Go actually start floating this around investors. See if they're interested in this potential deal. Again, before you spend all the money. Now, how am I going to raise money without legal docs, Bridger? Go and soft float this to investors. Go find mentors, people in your life. Hey, would you invest in this deal? If we actually paid for legal docs, did everything, would you actually invest in this? What you do is you build what I call soft commitments or verbal commitments into a deal before you go build it, okay, with the legal docs. Now, but Bridger, who's going to give me the money? I love this quote from Warren Buffett. He says, when I was young, I had a lot of ideas and not a lot of money. And now that I'm old, the roles have reversed, and I like investing in people with great ideas but just need money. Take a wild guess. What's the average net worth of a baby boomer right now? Anybody? Shout it out. $2 million, what did you say? 1.5, etc. I was actually spot on. The average net worth is 1.175. Isn't that kind of crazy? I did not expect that when I looked this up. The average, not like the high end, whatever, the average, the middle, is 1.175. There are a lot of baby boomers or people that are older generation right here. $84 trillion they control, and a lot of them are just like Warren Buffett. I want to invest into people and younger people that have ideas, funds, etc. that can just put my capital to work, okay? So next time you see a boomer, be nice, okay? All right? Be nice to them, because they've got a lot of money they're going to send your way, all right? So again, get soft commitments from investors, and then and only then, go and finish your legal docs. LPA, hire my brother, come out, and he can do all the legal docs, or firms like his to come and do our docs. Huge 100-page documents. Typically, just so you're aware, they're about, anyways, this is just from websites, $50,000 to maybe even $300,000 for docs. Now, you can reimburse those, though, back from your fund, okay? That was a pretty quick version, but the best way to launch a fund is through the fund launch format. Does that kind of make sense? 4 steps. Y'all are amazing. My name is Bridger Pennington. Thank you guys so much. Y'all are amazing. Thank you.